Brad Williams, Frugal Finance, pricing mortgage-backed bonds. Here we have a mortgage-backed bond. What we're going to do is look at the pricing. We're not going to get too in-depth here. This is just a quick overview. Let's just go over this. Let's make some assumptions here. Assumption number one, let's say these are AAA bonds. We have a $200 million, looks like $200 million in mortgage backs will be issued against $300 million pooled mortgages. Now, $10,000 increments over a 10-year period at an 8% rate. Looks like it'll kick off $800 interest payment annually for 10 years. That's based on these $10,000 chunks. The market is currently at 9%. There's an inverse relationship, price and interest. This particular mortgage-backed bond is going to be discounted because of that 8%, 9% scenario. 10 grand, just keep it simple. Annual interest, $800 annually, 10 years. The coupon, 8%. That means they're going to stamp an 8% deal here, but the market's saying we want 9%. What happens? We're going to have to discount this thing. So we're going to use this present value factor. We're going to use 9%, 10 years. We're just going to do annual compounding, $800, 10 grand. What's the price? 9,358. We're not going to get into this discount or dollar discount. We'll get into that later. This bond value now from 200 million is haircutted 187. 187. But that being said, this is purely an example. How about 7%? We have this nice 8% deal, but interest rates dropped. Reverse relationship. So what's going to happen? This 200 million is going to be selling for a premium. From this 187, it's amazing what percent interest rate will do. From 187 million to 214.4. How do we work that? Just go through and do the same format. Here's the scenario. Consequently, the bond will be priced at a discount of 642, equivalent to 93.58% of its par value, resulting in a yield to maturity of 9%. I just put up here market rate, which is actually the yield to maturity. You have to compute this as opposed to coupon. You don't know coupon from yield to maturity. Check out the present value. So in this scenario, the issuer will receive only 187 million after deducting all the other stuff. Conversely, if the required yield to maturity was 7%, you get 214 grand. So you could see how sensitive the yield curve is in the term structure when it comes to playing this fixed income requirement. Zero coupons, they're kind of willy-nilly, crazy little, in that they always sell at a discount. In other words, a $10,000 zero, you're only paying the discounted rate. And then over that 10 years, interest will accrue. What's the price of this thing at 8%? You're going to pay today for a 10-year at 8%, $4,632 for a $10,000 deal. How do we compute it? We're basically just doing the same thing. Notice we have C69, which is our interest rate. C70 is our term, and our maturity, look way over here. Check out the configuration here. We have a future value. We have a big switch here because we're selling this at a discount. We're looking at this C71. Work through these things. Read this if you want. It basically explains the duration and volatility. When you see a 1% change in a normal mortgage-backed bond versus a zero-backed bond, you're going to see a huge change in terms of pricing. You can see right here, you're getting, for instance, when the required return is 4%, the 8% interest-bearing coupon will sell for 130% of par, while the zero will sell for 68% of par. This is just a quick overview of this pricing. There are so many, many variables here. When we get into the options pricing, we get into some other detail in terms of swaps and some other fixed income calculations. We're getting into more complexity. But we're going to take baby steps in terms of the fixed income arena. More to come. Lots more to come. Brad Williams, Frugal Finance. Thanks for watching. See you soon.